Welcome to the Trading Desk, where we like to say money talks and conventional wisdom walks. My name's Dave Floyd of Aspen Trading Group here in Bend, and I'm joined by my good friend and colleagues, Matt Davio of Red Rock Partners and Jesse Felder of Felder & Company. And on each episode, we're going to provide you our very biased opinion on everything in the investment world, from stocks, commodities, real estate, and even foreign currencies. Before we get into this month's show, let's take a look to see what the markets did in February.
Last month, the S&P index was off again, February, 3.9%. We continue to fall, as you can see by the chart. Did your broker call the top, the double top there at 1560? Or is he just calling the bottom? Make sure to differentiate the two. Why did your broker not call the top yet is calling a bottom? U.S. dollar, the next chart, looks like still no bottom in sight. Today we're hitting a new low, March 6th, at $72.91. Again, this has got to bounce sometime, but the Fed has no desire to help the dollar at this point yet. Inflation? What inflation? I'm sure you're feeling it when you go to the grocery store. Take a look at the commodities index. It's through the roof. It's gone parabolic. I doubt it can keep going at this pace. We'll have to pull back. But prices are accelerating with the dollar depreciating. And finally, to go along with that depreciating dollar and increase in commodities, you've got the 10-year note, which is the basis for all mortgages. Typically, the 10-year and the LIBOR rates are what is used to determine your mortgage rates, not the Fed funds rate. That is just an intertrading mechanism for banks. So keep that in mind. 10-year is what you need to watch. 10-year currently trading at 3.6, again, getting near what we probably think will be a low here over the next few years. With inflation spiraling, the Fed really needs to be raising rates, but they're not doing it at this point. But I would watch out for this, as rates should tend to creep higher over time.
Welcome back to the Trading Desk. As you can see from the video that was just posted, the markets are once again unforgiving to long-term investors. We've had yet another decline in the market today. It's March 6th while we're recording this, and the Dow is down over 200 points. Year to date, I believe we are down 11% in the overall market. I guess some investors out there are just going, make it stop already. I know we've got a difference of opinion, but
I think we could play bull or bear, but it's very clear. I mean, I can show a chart to my 4 and 5-year-old children, and they tell me, "Daddy, that's going down." Yeah, right. If I flip that chart over, it would be going up. But it's pretty evident. I mean, we're in a bear market. We have been, as you talked about earlier, about 8 months.
And the cause is still the financial sector.
Still credit-driven.
Foreclosures are hitting new records. It seems like every month we're getting more foreclosures than we've ever seen in history. Banks are having more problems, and it just continues to get worse. And that's why we're seeing it reflected in prices.
Oil hit new highs today, almost $106 a barrel.
Gold's almost at $1,000.
Gold's at $1,000, let's call it. Yeah. Commodities are through the roof. Dollar's getting hammered to all-time lows again today.
Right.
I mean, it's continuing.
So basically, consumers are getting pinched. They have high prices on groceries and gas and all these things, and their home prices are going down. It's the worst of both worlds.
Jobs are starting to get pinched, and what you're seeing going on in real estate, I believe, right now, is carrying over into Wall Street.
For sure.
Wall Street is taking as much pain as they can. They're writing off their losses as best they can figure out what those losses are today.
Right.
And that will trickle over to the consumer, as we know. It always does.
At some point.
It follows Wall Street. It always follows Wall Street.
And I think the thing that we've always talked about on the show here is that, one, this is not really a big surprise if you were paying attention over the last few months. And two, I don't think you have to put yourself in this position from an investing standpoint. I think a lot of this was avoidable to some degree. And I think when we come back in the next segment, we're going to delve into this a little bit more, get some more details. So when we come back, we're going to get right into that. We're going to talk about how you can structure your portfolio to be a little bit more defensive or, more importantly, more profitable. You're watching The Trading Desk on COTV, and we'll be back.